One of the first questions I get asked by you is, how much insurance do I need? Getting this right is the foundation for making sure that your insurances are set up properly. So I'd ask you the question, if you already have insurance, how did you come up with the number that you've insured yourself for at the moment? If you're a Barefoot Investor fan, chances are you've used the multiple of salary method that Scott presents in his book. Now, whilst this is a good starting point, in this video, I'll share with you how I believe that this is flawed, particularly when you're looking to review that cover in the future. In this video, I'm going to share with you, number one, the principles that I use for calculating how much insurance you need to make this a personal number for you based on your exact specific needs. Number two, I'll show you how this leads to following another principle that I have, which is having minimum levels of cover at all times. And finally, number three, I'll show you how this will provide you with a framework so that you can come back and revisit the insurance needs that you have as time goes on to make sure that you can adjust the cover levels accordingly and have the right levels of cover, not only now, but in the future as well. As I mentioned before, getting the foundations right when it comes to your insurance is critical. Now, I know for a lot of you, getting your insurances sorted, it's not really something that you want to be doing. So most of us tend to want to put it on our to-do list and then tick it off as quickly as possible. What I hope this video will explain to you is the pitfalls around trying to get this done quickly as opposed to getting this done properly. At the core of this video, I'm going to show you how you can have an insurance story that can build out exactly why you've got the cover levels that you apply for your insurances. So firstly, I'm going to share with you the principles that I use for calculating how much insurance you need across the 4 types of cover. So firstly, let's have a look at life insurance. For me, getting your life insurance sorted properly has 4 things that you need to consider. Point number 1, I want to make sure you've got a debt-free family home should anything happen to either of you. Point number 2, I want to make sure you've got a replacement income so that the surviving spouse can become super mum or super dad for a period of time. Now, what this means is that instead of having to rush back to work if one of you were to pass away, the surviving spouse has an amount of income that's provided for by insurance that allows them to stay at home, take care of the kids, do whatever you need to do to make sure that the family unit has as little disruption as possible. Now, the biggest variance that we see here is the amount of income that's required. So how much money do you need to run the house if you didn't have a mortgage? And secondly, how long is this replacement income required for? Now, depending on the spouse, if this is the main breadwinner or the non-main breadwinner, this number may vary. So this is where some personalization and specific questioning can help unlock some of these answers for you to provide you with a really personalized and tailored insurance solution. Thirdly, I think once you've got this number, you need to net off any proceeds from superannuation funds, investment property, shares, cash, all those sorts of things that you have that would be paid out in the event of something happening to you. What this does is it allows you to maintain that minimum level of cover or reduce the amount of gap that you have for an insurance need. Ultimately, we could spend as much as we want on insurance, and if money was no object, sure, you'd go and do that. But in reality, we all have a limited budget that we're prepared to or want to put aside to spend on insurances. The 4th point that I like to cover when it comes to life insurance is having some money for funeral and final expenses. Now, this could include estate costs, tax, all those sorts of different things. Just a flat amount of money to take care of those things is really important for you, and that's how I come up with the level of cover that I believe you need for life insurance. Now, let's have a look at total and permanent disability cover. For TPD, this is the cover that you might have attached to your superannuation fund. I again believe that you should clear the debt that you have on your family home should anything happen to either of you. In addition to this, I believe in providing some money for modifications to the home. So in the event of TPD, there's 2 doctors that have told you that you can never work again. So it's likely that you're going to need to make some adjustments to the home. I call this crudely R&R, ramps and rails. This money will allow for you to make those modifications to the home to make things that little bit easier for you. The 3rd thing I like to cover is an amount of money for a carer. Now, depending on the situation, in most cases, the person who hasn't had the injury in a couple would often become the primary carer in the event of a TPD. Now, this is a pretty onerous role from my experience, and the idea of having that carer come in allows you to have the money so that you can be confident that your loved one's been looked after, firstly, and secondly, do something for yourself so that you can go and freshen up, because the role of a carer is all-encompassing. It's completely taxing, and this money allows you to have just that time and that breathing space to go and do something for yourself. For trauma insurance, I'll share with you now my principles for how to calculate how much cover you need. The first principle I like to do is provide a replacement income for you so that you can do whatever it takes to get better. I look at 2 years worth of net income on the higher income if you're in a couple, and that'll provide you with an allowance so that you don't have to rush back to work. Now, there's some other videos that'll explain the difference between trauma and income protection and where this is really important. The second point, I like to provide an amount of money for medical expenses, again, to do whatever it takes to get better. This additional money gives you that peace of mind that even if you can't go to a public hospital or it's not included in your private insurance, you've got the money that you need to go and do whatever it takes to get better. When it comes to looking at income protection, I think you need to first look at whether or not, should you be unable to work and you don't receive income anymore, would this have a big impact on your ability to run your household? If the answer is yes, then I believe you need to consider income protection. For me, the first thing to consider is a waiting period. How long can you be off work before you need to get some money coming through? Bearing in mind that a 30-day waiting period is about 40% more expensive than a 90-day waiting period, I think it's important to note that fact, and trying to find an appropriate one might often mean that you have a backup plan such as a Mojo account or additional cash that will get you through this period of time, in addition to your sick leave, annual leave, that sort of thing. The next thing to look at is the benefit period. Now, many of the super funds offer a benefit period of 2 years. Unless you're nearing retirement, I find it difficult to see how that 2-year benefit period would provide adequate replacement should you be unable to work ever again. So for me, looking at that longer term benefit period to age 65 to age 67 or 70, I believe is the most important way of looking at it for your income protection. Now, when it comes to how much you can insure for income protection, you can insure up to 75% of your pre-disability income plus super contributions. Now, it's important to note this, that if you were early 30s or in your 40s and you were unable to work again, it'd be great to get that replacement income. But if you didn't have those super contributions added on top of the amount of income you received, the balance that you had in your super would be equal to what it is today, plus growth in that period, and you'd miss out on all the contributions that were going into the fund along the journey. So I think it's important to consider the impact of this, and my recommendation is to take out that additional contributions to go towards your super as well. Now, there's some technical terms between agreed and indemnity contracts when you look at income protection. These come down to the proof of your income, whether you do this at application or at claim time. And depending on your situation, again, proper questioning and techniques around this will make sure that you've got an appropriate package for you based on your need, and again, help you to be able to tell your insurance story. So these are the principles that I use when I'm looking at the 4 different types of insurance packages for you. It's not a matter of just picking a number out of the air. Now, I get asked a lot, well, what do most people do in this scenario? And it's not as easy as that. It really does come down to answering those questions and working out what an appropriate level of cover is for you. So how does this all lead to you having the minimum level of cover at all times? If you're anything like me, the amount of money that I spend on my insurance is never something that I love doing. So I believe it's really important to follow these sorts of frameworks to give you an idea of how you can come back and revisit your insurance needs over time. Now, if you've had insurance for a little while, you would have noticed that each year, as you get older, your premiums go up. This will continue to happen, and the older you get, the more expensive the premiums are. What most people do is, as you get older, the premiums get to a point where they just become ridiculous and get out of control. So, like most people, we cancel that cover coming into those times that we're most likely to claim on the insurance that we need. To combat this, I believe that if you follow the principles that I shared with you earlier in this video, you'll be able to tell your insurance story. As your needs change over time, you'll be able to revisit the way that you calculated the sums insured that you have and adjust the cover accordingly. Now, for most people that I speak with, the time that they come to me to do their insurance is when they have things like starting a family, taking on new debt, those sorts of things. So the need for your insurance at those times are at the highest they will ever be. So once we've done this the first time, all we'll need to do is come back and adjust the cover levels based on the changes that you have in your personal circumstances. By having this insurance story that we've been able to tell, it's very easy for us to come back and revisit this number based on the changes that you've had in those certain areas. For most people, the reduction of the cover as we get older means that the premiums are kept more affordable, and therefore giving us a greater chance of holding the cover cover when we need it as we get older in the periods of time that we're statistically more likely to claim on the insurances that we have in place. This brings me on to point number 3. By telling yourself this insurance story, you'll have a robust framework to come back and review your cover levels in time. Now, if you've done your insurance before, I'm sure it's, again, been one of those things you had on your list, you ticked it off, and it's rarely one of the things you come back and revisit. I believe that we don't revisit this very often because most of us don't have the story or a framework to know what we're doing when we're looking at how much insurance we have in place. Then the only driver to what changes we make comes down to price. How much has the price changed from last year to this year? And I think we've got that completely backward. If we change the narrative on this one, what we need to do is we need to look at what needs do we have this year that are different to last year and adjust our cover accordingly. Now, for most people, as I mentioned, this is reducing cover as we get older because our assets are getting more, our mortgage is coming down, our kids are getting older, all those sorts of things are putting a downward pressure on insurance needs. But conversely, there are some times that we do need more cover. So if we meet before you've got kids, after having kids, or after taking on more debt, then there is a chance that the need for insurance will change upwards. If you don't have the framework for how you calculated the amounts of cover that you have, then you've got no framework for revisiting this either. So this is why it's really important to write your own insurance story. So there you have it. I've provided you with the way that we structure your personalised insurance story. If you're new to this channel and you like videos like this, hit the subscribe and the like button and share it with your friends. Appreciate you watching, and I'll see you next time.